Welcome, everybody. I hope everyone's doing well. My name is Tom Dixon. I am the host and chief organizer of the Financial Experts Network, and I'm certainly delighted to have you here today for a special session on student loans. Everything and anything about student loans is, in particular, on one hand, what's possible now with the CARES Act, but also all of those issues and much, much more with someone that I was just sharing privately before I started the session, Heather Jarvis. I've wanted to have Heather on for years, so it's a real treat to have her on. For those of you not familiar with Heather, she is, again, an absolute expert. She is someone that has really dedicated her professional life to really bringing about change in the area of. Heather, thank you so much for joining.
Thanks so much, everyone, for coming and for your interest in learning more about student loans. It's something I've been thinking about for an awfully long time. What we are going to talk about today, among other things, whatever it is that you want to talk about, we're going to just start by reminding ourselves of the importance of how interest accrues, particularly over the passage of time, which I think is something that we have to take care to explain to clients and student loan borrowers because it isn't particularly intuitive. We want to talk about particularly today the CARES Act and its interest waiver and payment suspension and how that will affect student loan borrowers. Particularly, we need to know which loans qualify for this interest waiver because not all federal loans do and no private loans do. So I'll give you the skinny on that. We'll discuss in particular the impact on borrowers engaged in income-driven repayment options and those pursuing public service loan forgiveness. They have rather complicated situations. I wanted to address some points there with you. And then we'll discuss the borrowers who might benefit from continuing to make payments on their student loans, even though they are not required to do so during this period covered by the CARES Act. Some people benefit, others will not. And so we'll look to see whether payments made can reduce the principal balance in a particular borrower's circumstance. And that will require us to, delve into a little bit about how capitalization and interest accrual is different with regard to student loans than it is with regard to some other kinds of consumer debt that you may be more accustomed to looking at. And also, we'll talk about specifically whether this is a good time for clients to consolidate or refinance their student loans. And I distinguish between those two terms pretty specifically, so we'll talk about that too. But so to begin with, the basics that we all want to keep in mind whenever you're talking about debt management is how the cost of borrowing, which is primarily the interest that a borrower pays, that interest is a result of the principal balance that's borrowed, as well as obviously the interest rate, but also the passage of time impacts the amount a borrower will pay. So, the faster that student loans and other debts are repaid, the less time there is over which interest will accrue. So, for example, a simple example that might represent, say, a graduate or professional student borrower would be, let's say they borrow 100 grand at a 6% interest rate. Well, what that means, and what many borrowers are, rather shocked to learn, is that means that about $6,000 of interest will accrue over the course of the first year that the $100,000 balance is owed. And that's $500 a month just to keep owing 100 grand for a year. And obviously, if you owe 100,000 for longer, you're going to pay more money, 60,000 over the course of 10 years. And so one way to reduce the costs of debt, and typically the kind of foundational principle, is to pay quickly. And the faster you pay, the less interest will accrue because the shorter the period of time will toll while repayment is underway. But of course, there are other parts of this equation, and an important one being the rate, the interest rate at which interest accrues. So interest on federal student loans is set by Congress. It's baked into statutory law. And since the year 2013, Congress has set interest rates based on market conditions in part. They do a 10-year Treasury note auction in the spring and then add a specific margin. And so on the one hand, it's tied to market conditions, but they're not the same as variable interest rates. They don't change with market conditions. They're simply set with regard to market conditions for the upcoming academic year. So, I like to explain when I'm working with student loan borrowers about how the interest rate affects the amount of interest that is due and payable. Looking again at our example of a person who borrows $100,000, if he's paying it at an 8% interest rate, it's $8,000 of interest in a year, whereas at 6% it's $6,000, at 4% it's $4,000, and so on. So obviously reducing the interest rate is one way to save money over time. So a person who borrows money is going to pay it back plus some. And the plus sum that they pay back is going to depend on the amount of time over which they pay, as well as the interest rate that's applicable to the loan. And certainly, obviously, the amount they borrow, the principal amount, is a big part of that equation as well. Now, federal student loans are very special and unique. They stand out from all other kinds of consumer loans and all other kinds of student loans. They have very flexible repayment provisions, which is truly a double-edged sword for student loan borrowers in that federal student loans allow borrowers opportunities to pay less than the interest than is accruing on the loans. And that's unusual for debt. So typically when we borrow money, we have to pay at least the interest that's accruing, and usually we have to pay somewhat more. And most loans we get, like an auto loan or a mortgage, will be paid back over a specific length of time or term. 30 years for a mortgage or 5 years for some auto loans, for example. But with a student loan, the payment may be spread out over a specific period of time, or it may be that the payment is tied to the borrower's income, and the payment amount may in fact not be determined based on how much the payment has to be in order to pay off the debt over a particular period of time. And those are primarily these income-driven repayment plans that are a huge part of understanding strategy and advice with regard to federal student loans. We'll talk some about income-driven plans today. There's a lot more detail to know about it, so there are other opportunities for you to learn more of those nuances. But when I say an income-driven plan, I'm talking about one of many repayment plans that borrowers of federal student loans may choose. They all have their own acronyms, IB, RIC, RPAYE, and all these other ones. And they're very similar, but have really quite significant and nuanced differences that can make thousands or tens of thousands of dollars worth of difference in a given borrower's circumstance. Also very special about federal student loans, and what complicates things tremendously, is these loan forgiveness provisions that are associated with federal student loans. There are two primary ways to get some federal student loan debt canceled or forgiven, although there are a number of additional complications. One is public service loan forgiveness, my particular favorite, and public service loan forgiveness is tied to employment in public service. A borrower has to make 120 so-called qualifying payments over a period of at least 10 years. And if he or she makes payments that are driven by income and makes these payments over the course of 120 months while working full-time in public service, the balance remaining is canceled and forgiven. And there is no tax assessed in that instance. But there is also another path to some federal loan forgiveness. that is similarly tied to the selection of an income-driven repayment plan. And that's more of a long-term forgiveness that's not tied to employment at all. It's simply tied to the borrower's debt-to-income ratio, essentially, and a person has to owe enough as compared to how much they earn that something is left owing after, in most cases, 20 years. And that long-term forgiveness that is not tied to employment, that is taxable. The forgiveness itself is taxable as income in the year in which it is received. And so these forgiveness opportunities mean that it's not always best to pay as quickly as possible, like Usain Bolt style, because in some cases, a borrower does not have to fully repay their entire principal balance and all the accrued interest. They may be eligible for some cancellation. And that's the sort of complicated evaluation that advisors like yourselves can help consumers and borrowers make. It's not particularly intuitive or easy to do. And so that's one of the reasons I'm super thrilled that you are interested in learning more about this subject. And if you are a super nerd like me, you have loads of opportunities to learn all kinds of detail that you can use to really help people not pay more than they should. So also things that are special about federal student loans are the opportunity for things like a postponement of the obligation to pay. The feds call postponing payments two different things. Deferment or forbearance means basically the same thing, except that during a period of forbearance, interest accrues on all the loans, whereas during a period of deferment, there are some loans called subsidized loans on which the interest does not accrue. Now, those subsidized loans are limited to people with financial need, and so you'll see them somewhat less commonly. But in general, deferment and forbearance have a similar effect on student loan borrowers. Also special about federal loans is the possibility of discharge, complete discharge of the obligation to pay upon the death or total and permanent disability of the student loan borrower. So these consumer protections are really quite special, and they attend to federal student loans only. We have today on our topic an example of how a federal student loan provides for a more flexible repayment option in times of crisis. Specifically, Congress passed and the President signed into law the CARES Act, the Coronavirus Aid, Relief, and Economic Security Act. This was signed into law on March 27th, but is being applied retroactively to March 13th, which was when the administration first announced that payments would be suspended on certain kinds of federal loans. And so borrowers who have, air quotes, federally held loans are not required to make payments through the end of September under the CARES Act. It's possible that legislation in the future will cause this period to be extended or for additional provisions to be enacted. Also during this period, interest rates have been set to 0 for these federally held student loans. So federally held student loans are subject to this interest waiver and payment suspension. Well, what are federally held student loans? Well, there are lots of federal loans, but there are many that are not covered by this as well. Approximately, based on our best estimates, about 9 million people with federal student loans have at least one federal loan that isn't covered by the CARES Act. They also have potentially private student loans significantly not covered by the CARES Act. The loans that are definitely federally held are those with the word direct in the name of the loan, direct loans. And so most of the commercially held federal loans, those that are not federally held, are going to be older student loans. They're going to be borrowed before the summer of 2010, so more than a decade ago. But you may be aware that many people have student loans that are far older than that. And so before the summer of 2010, there was a federal student loan program known by its acronym FFEL, Federal Family Education Loans. And those loans begin their lives as commercially held loans. They're originated or funded by banks and private lenders. They can become federally held loans, and that occurs in some circumstances. It can occur if the borrower chooses to consolidate into the direct loan program. It can occur if the Department of Education, for some reason, buys some of those FFEL loans, as they have done. And it also happens when one of those loans enters a default status, which occurs only after 9 months worth of missed payments on the part of the borrower. And that's because they're guaranteed by the federal government. And so the way that that's handled is that they're acquired during the default process. So the loans that are not covered are going to be those older federal loans that have not entered default, have not been consolidated, or have not been purchased by the federal government. The purchasing of those FFEL loans happened a lot during the last recession in 07-08 time period because the FFEL lenders were having issues of liquidity, and the Department of Education was injecting capital so that the FFEL loans could continue to be originated for new borrowers. And they did this by purchasing some of those loans. So Perkins loans are also more often than not commercially held, in that they are federal loans, but they're originated by campuses. And so they're often owned by the school the student attended when the loan was borrowed. But significantly, private loans are never covered by the CARES Act, and neither are the health professions loans known as HEAL loans, unless they've subsequently been acquired. So how are you going to know if your client has a federally held student loan? Well, you can direct them to the studentaid.gov website. And at the studentaid.gov website, they can log in with their federal student aid username and password. They'll see the account dashboard view. And if they drill down through the details to the loan types, they'll be able to look to see whether the name of the loan has the word direct. It will say something like direct unsubsidized or direct plus or direct consolidation if it is a federally held loan. If it's not, they'll have to look further and look to see who is the current lender or loan contact, and it will say U.S. Department of Education. So not as straightforward as would be good, but in any event, more recent borrowers and recent graduates will more likely to have federally held federal student loans. All right, so what does the CARES Act actually do that's of use to folk during this pandemic? Well, it depends on their situation. For borrowers who are already enrolled in an income-driven repayment plan, the time that the payments are suspended will count as time working toward that long-term forgiveness, that 20 or 25-year forgiveness, the taxable forgiveness. So even though payments are not occurring, progress is being made toward forgiveness. For people who are working toward public service loan forgiveness, they will also be enrolled in income-driven plans typically. They may count these months towards the months required to earn the 120 payments necessary to achieve public service loan forgiveness. So that is a great relief for those borrowers. And similarly, borrowers who had entered an agreement to rehabilitate a defaulted student loan will be able to continue progressing toward rehabilitation, even though they're not actually making payments. Typically, rehabilitation requires 9 out of 10 months payments on time to be made in order to realize rehabilitation of a defaulted loan. If you're not enrolled already in one of these plans or have your loans in such a posture, it is not clear that you'll be able to make the changes necessary to progress towards these forgivenesses or rehabilitation. Although some of the recent guidance coming from the Department of Education indicates that perhaps people can make these agreements or choose these repayment plans and get that situated and gain some couple of months towards the end of this period towards those specific programs. I haven't seen that the loan servicers are processing things in a particularly expeditious manner, however, and we'll talk about that a little more here momentarily. So what does this mean for action steps for advisors or for borrowers? Well, it depends again on who we're talking about and what their circumstance is. If someone is likely to benefit from public service loan forgiveness, they owe enough as compared to how much they earn, and they intend to remain in a public service job, and they're on track. They don't have anything to gain by continuing to make payments during this period of suspension. They would be better off prioritizing repayment of their private student loans if they have any, or other debts like credit cards, or even other financial goals that you may advise them about, like an emergency fund or retirement savings or the like. And in any event, people who are working towards public service loan forgiveness should take care to be certifying their public service employment by using the employment certification form process, and should be extra cautious to ensure that the payments they are not making, that this period of suspended payments is properly counted toward forgiveness. The servicing companies have difficulty doing that count properly in good times, and during the pandemic, like everyone else, they're struggling to adapt to the new circumstances. But for those for whom public service loan forgiveness is unlikely, they're likely to either pay off their loans themselves out of their own pocket, or perhaps earn this long-term forgiveness, which is taxable. So in the case of taxable forgiveness, there is an incentive to reduce the amount that is forgiven, because you have to pay tax on the amount that is forgiven. So it is not as clear that it doesn't matter what their balance is when it's forgiven. And so those people might have an opportunity to reduce their principal balance and thereby reduce the interest that accrues over time by paying down the principal balance during this period of an interest waiver. But the sort of funky thing about student loans that has to be addressed is this whole possibility of unpaid accrued interest. So if you recall our simple example of someone who owes $100,000 at a 6% interest rate, has about $6,000 or interest a year accruing, or $500 a month. Let's say that person had been enrolled in an income-driven repayment plan and was paying payments of $300 a month when there was $500 a month of interest accruing. Well, in that case, the $200 that was unpaid in a given month remains outstanding and owable. Owable, is that even a word? And it is owed. But it is not, unlike other kinds of debt, it is not immediately capitalized or added to the principal balance. So interest does not continuously compound on student loans as it will with other instruments that you may be familiar with. With student loans, interest is capitalized upon specific triggering events. And those triggering events occur during the life cycle of the loan. The biggest time being for most borrowers, the conclusion of their grace period, which is the typically 6-month period after graduation before which payments are due. Interest accrues on most kinds of student loans from the minute that they are dispersed. So interest accrues for most loans while the borrower is in school and during the grace period. And unless the borrower paid it as she went, then it will capitalize that unpaid accrued interest upon the conclusion of the grace period when they first enter repayment. And now some borrowers will then keep up with the interest and then some all along. But many borrowers in income-driven plans, or those who choose to suspend their payments by way of forbearance or otherwise, will have interest accrue that is not paid. And so if there's interest that's accrued but hasn't been paid, what happens when that borrower makes a payment? Well, there are specific rules about how a payment is allocated. And it's allocated first to whatever interest had accrued since the last payment, so typically over the course of the last month. If the interest that accrued over the previous month is fully repaid by the payment and there is more left in the payment, it then is attributed to unpaid accrued interest from previous periods. And it is attributed to that unpaid interest until that interest is fully repaid down to zero. And you cannot repay or reduce your principal balance unless or until that interest is fully repaid. And so it's important to determine whether and how much unpaid interest has accrued in order to get a sense of whether it's possible for a given borrower to reduce his or her principal balance during this interest waiver and payment suspension. And as I've said kind of a couple of times here before, keep a close eye on the loan servicing companies. So loan servicers are those businesses that are hired by the federal government, typically in this case, or by other lenders to administer the loans, to bill customers, receive payments, and the like. And you know, I'm not shy about saying that that the loan servicing companies have historically done a terrible job for student loan borrowers. In my view, they've not done well by the federal government or the taxpayers either. I certainly understand that the people who work there are good people doing the best they can, like any of us, under difficult conditions, and the system is set up such that the incentives are misaligned in my view. So I always tell student loan borrowers, you know, don't get your financial advice from your debt collector. And the student loan servicing companies are much more, in my view, appropriately thought of as debt collectors than they are as, you know, sources of reliable, nuanced information for student loan borrowers. But sadly, borrowers have to rely on them for pretty much everything, including things like, you know, counting their payments toward public service loan forgiveness, which Fed loan servicing in particular has struggled mightily to do. So I encourage you as advisors to recognize the reality of the system in which your clients must operate with regard to their student loans, and help them navigate the difficulty of it and advocate for their own best interests. The servicing companies are more prepared to handle the kind of typical undergraduate borrower, a person who owes $30,000 and no more. The advice that a person who attends a graduate or professional school who owes, you know, 6 figures of student loans, it needs to be much more specific and holistic with regard to financial health. And so it's especially important to look over the records and ensure accuracy and fight for the rules to be applied fairly. I will say one other note in that regard before I refer to consolidation and refinancing for our last few minutes of my presentation. Apparently there is a rather new issue with regard to credit reporting coming out of the Great Lakes Student Loan Servicing Company in particular, that is erroneously reporting late payments for borrowers who should be subject to the suspension of payments under the CARES Act. There's a lawsuit pending, and there will be a lot of advocacy around correcting those inaccurate credit reports. But that is just the latest example of how, truly difficult it is to run a large system such as the student loan system we have. And, the student loan borrowers are not well positioned to protect their own interests, and the system is not designed to do that, and so it doesn't do that very well. So I wanted to talk a bit about consolidating and refinancing, and in particular, I want to make a distinction between those two terms. So when I talk about a consolidation loan, I'm specifically referring to a federal student loan called these days a direct consolidation loan that repays other federal student loans. And when I say refinancing, the reason I use two different words is to differentiate and to refer to a private refinance loan as the kind of loan a borrower can qualify for with a private lender or bank, and can use that refinancing loan to repay private student loans, federal student loans, or a combination of both. So refinancing is typically done by borrowers with secure financial situations who are looking to improve their interest rates. Consolidating, on the other hand, is not about improving interest rates, because consolidation loans have interest rates that are the weighted average of the underlying loans. And the underlying loans are always federal loans with interest rates set by Congress. And so the interest rate on a consolidation loan is going to be blended from the loans underneath, depending on the balance that each one represents. And that isn't a way of lowering the interest rate. In fact, some borrowers will end up with a slightly higher interest rate because there's a rounding to the nearest eighth of 1%. And there's also a borrower incentive that may be lost, which is when some of the commercially held federal loans were issued interest rate reductions based on the borrower's responsible repayment, things like automatic debits or some number of on-time payments. And those borrower incentives are waived upon consolidating. So consolidating is useful for people with older federal loans that need to get them into direct to be eligible for public service loan forgiveness, for example, but it's not a way of improving interest rates. The only way to improve interest rates is to refinance with a bank or a private lender. So on the one hand, now is a great time to refinance because interest rates are rock bottom low. On the other hand, the reason that people get pretty good interest rates on private refinancing loans is because the private refinancing lenders are very picky about the loans they issue, and their underwriting standards are rigorous. So they will be looking for people who have strong credit scores, good, solid, and long credit histories, and secure employment with substantial income as compared to debt. And importantly, a student loan borrower would have to waive all the special federal protections in order to refinance. They would have to give up their access to loan forgiveness, to income-driven repayments, to suspension of payments in times of national emergency or otherwise. And so, yes, interest rates are low right now, and so a few people, the right people, could benefit from refinancing. But on the other hand, this is a time of great uncertainty. And so that makes for difficult decision making. I have some recent statistics, although recent, they are pre-pandemic, so maybe somewhat less instructive than they might otherwise be. But just so that you get a sense that the people who have successfully refinanced in the most recent year for which we have statistics, they have very high credit scores and they have good, strong incomes. And yes, they're getting good interest rates, but they're not getting, 0% interest rates at all. So, while I say this is a good time to refinance, I don't mean this month for someone who has federal student loans, because they may have a 0% interest rate until the end of September, potentially even longer. And even the very best borrowers are paying something on interest for a private refi, because again, they're unsecured loans. So you're never going to get an interest rate like you would get on a car loan, where they can come and take the bends out of the driveway if you don't pay for it. But if you are looking to into refinancing or advising folks about refinancing, I find that there are a number of features that are worth looking at. So obviously interest rates are going to be the biggest driver of what is a good refinancing loan, because that's really the main reason to refinance, is to reduce an interest rate. But it will also be important to consider what the repayment term is. And the longer someone wants or needs to repay the loan, the higher interest rates they're going to be offered on the private market. So if they can pay quickly, that will lean toward the advantage of refinancing. Many refinance loans require cosigners, but they sometimes include a cosigner release provision, which, as do private loans generally, those are worth looking for in every case in which you're looking at private loans. If the cosigner can be released after some qualifications are met, some number of on-time payments typically, for example. It's also worth considering the sort of customer service that is available through various banks or their loan servicing companies. But I like to remind, myself and the borrowers that, most private lenders or private refinancing companies have no alternative but to hire one of the multiple loan servicing companies that is out there. And they do tend to be the usual suspects who tend to provide the usual customer service, which is, in my view, inadequate. Also, private refinance loans always lack the consumer protections that federal student loans have. They're never as strong, but some of the newer companies are trying to inject some provisions that will mimic some of the federal protections, particularly like a death discharge or disability discharge provision. They're not as rock solid as the statutory protections are, but it's better to have something rather than nothing. And also, as advisors, this provides an opportunity for you to let people know about the importance of having appropriate kinds of insurances, like disability insurance, for example, particularly for someone who decides to refinance student loans. He or she might need some extra disability insurance just in case, God forbid, something should happen. They wouldn't have the federal disability discharge provision, so they'd likely still be required to make payments on that private debt. It would be nice to either have a disability discharge provision in the loan, or if not, plus up the disability insurance, because it has to cover those student loan payments.
So David is asking, Heather, what is the story for Parent Plus student loans? Forgiveness or refinance?
Well, the answer is it depends. So Often refinance can be a good idea. Forgiveness is possible. So a Parent Plus loan is a federal student loan that a parent of a dependent undergraduate student can borrow in order to help their child attend undergraduate school. And some parents end up owing a lot on Parent Plus loans because the borrowing limit is all the way up to the cost of attendance. So students can only get, for example, a freshman undergrad can only borrow $5,000. That doesn't go very far to pay for undergraduate education, but her parent could borrow up to the rest of the whole tuition fees, cost of living, and the whole shebang. So, but Parent Plus loans are only eligible for the income contingent repayment plan, not the better, cheaper income-driven plans. And even then, they have to be consolidated before income contingent is available. So forgiveness is only going to pan out for those parents who owe rather a lot as compared to how much they earn, or who are themselves public service workers. So a parent could earn forgiveness of his Parent Plus debt by working in public service, but it isn't tied to the employment of the student borrower. So there's complexity there. So it's a great question. Sometimes refi is the right way to go. Sometimes forgiveness is possible. And it really depends on the factors of debt to income ratio, employment, as well as credit history and credit worthiness in the eyes of the lenders.
Great. And I have a question that came in early, but I'm going to table it until the end, and we can open it up and you can get a little animated. And it has to do with a certain Department of Secretary of Education. But again, let's table that. Heather, we'll leave that until the end so you can be even more expansive. Okay, great. So again, Ted, good to see you on. Here's a question from Ted. Years ago, he loaned one of his students some, give me 1 second. I think he loaned one of his students some money for, I'm assuming for a college education, but without paperwork and interest. He did it interest free. Very admirable, Ted. And he's asking generally, did he make a mistake? And he's saying now these students are grown, and I'm not quite sure, Ted, whether that's paid off or not. But again, Heather, I'm not sure if that's enough to go on, but I'll let you comment from there.
Well, in general, my philosophy of life is not to loan money to that I expect to be repaid. I'd rather, if I can afford to give money to those who need it, and I will do that. I don't myself prefer to serve as a lender, particularly in those kind of casual situations, because I think that they can cause problems for relationships. I will tell you that under the circumstances that you loaned that money, it won't be considered a student loan in any sort of legal sense. So you wouldn't get as a lender, you wouldn't get the extra protections of, things like the lack of bankruptcy discharge or the like. You may be able to pursue other remedies. Certainly it's a valid contract. You don't need to have it written down, but it wouldn't be subject to any of the sort of special rules about student loans.
Yeah, great. And again, just as a reminder, I see Kristen's question. Again, if you're interested in CE for today, you can register after the session and still qualify for that credit as sign up as a member. I will say I'm going to do a special podcast someday on what I learned from lending money to countless family members and friends. And it took me about the third loan, as Heather makes the point, before I realized it wasn't a loan, it was truly a gift. So take that for what it's worth. So next to question from Linda, is the zero interest included for current students who are not currently in repayment? Good question.
It is, yes. So it's an excellent question, and yes, it is. And current students are borrowing federally held federal loans. So to the extent they have federal loans, those loans are at a 0% interest rate until the end of September, unless an extension is passed.
Yeah, and that just reminds me, in addition to Heather's website, as a second source, how about this, Heather? The Wall Street Journal does a lot of great content. I'm a big fan of, I'm sure many, if not all of you read it, but on the weekends and then, once or twice a month, they'll have great content on student loans and all kinds of things, right? But I'm just reminded of this as I see that question about, boy, they really do, I think, a great job in terms of keeping you up to date. Heather, you're welcome to add your comments on that and any other sources that you like.
It's funny, I have an email that just came in before we launched this webinar from a reporter at the Wall Street Journal, specifically asking about that Great Lakes credit reporting issue that I have to get back to her on. I do love, I recommend everyone to the National Consumer Law Center. In particular, they have a website called Student Loan Borrower Assistance.org, not the best URL ever, studentloanborrowerassistance.org. But if you need a place to refer borrowers who are struggling financially or who may have issues of default or delinquency that you're not prepared to handle, I know that you got to be in a situation like I am as a financial advisor. Many people are struggling and reaching out for help, and you're not in a position to help everyone, and not everyone is in a position to hire you. And you can't always work for free, right? I have to keep reminding myself of that. Tom, no, just kidding. That you, so you have, student loan borrower assistance is absolutely reliable, consumer focused, borrower advocate type of information, that people can really rely on. So I like the National Consumer Law Center an awful lot.
All right, quick update, by the way, folks, just so everybody knows, full disclosure, over 40 of you, I wasn't going to announce that, have inquired and want to be contacted by Heather. So everything will work out, Heather. There's my barter. All right, so next from Russ, touche. Next from Russ is, did I hear correctly that forgiven loans will be subject to income tax?
Yes, so the public service loan forgiveness is not taxable, but the long-term forgiveness that's not tied to employment, the income-driven forgiveness, taxable as income under current law. That's correct.
Good clarification. All right, I'd missed that second part, Russ. I'm glad you asked. So next from Frank. Frank is asking, is there a downside to refinancing government federal loans with a private bank lender?
The biggest downside is the waiver of the consumer protection. So if everything goes great for that borrower financially, and he or she never has an unexpected period of unemployment or an illness or an injury or a dip in income, then it may well be the best thing, because it can really save money and interest, especially for people who have high interest rate federal loans and who can qualify for a low interest rate private loan. But private loans are much less flexible, and for regular humans, they're usually more expensive. I think of private student loans as kind of for the anesthesiologist set. They're best for people who borrow a ton of money and make a lot of money and are secure in that. But they can also be good for people who have no chance of forgiveness because they only owe 20 grand or whatever on federal loans. They're not going to qualify for any forgiveness, and lowering the interest rate is the most important thing. It's just that qualifying for those private refinance loans is really hard. They cherry pick the very best borrowers, and lots of folks have a hard time qualifying for a good loan or a good rate.
Yeah, that makes sense. By the way, reminder, and I'm sorry I failed to mention this at the beginning, a copy of the slides are available in the handout section in the GoToWebinar interface. They were also emailed to you in advance. In fact, you can go to the website, financialexpertsnetwork.com. There's a link, should be /materials, or I believe guests. And again, you can find it there, or again in the section there. Second, if you need to jump and you're worried about having been on sufficient amount of time to qualify for CE, we hit that mark. You've earned your CE credit for those of you that are members and are interested in that. So, all right, great. Back to questions again. Next is Josh. Josh is asking, is it actually true student loans cannot be discharged in bankruptcy?
No, that's not true. Student loans are what we call presumptively non-dischargeable in bankruptcy, and all that really means is that when someone enters a bankruptcy proceeding, all of their debts, with the exception of student loans and taxes and back taxes, are presumptively dischargeable. So they presume that they will discharge them unless something else is shown. Whereas with student loans, they presume they will not discharge them unless something else is shown. And that something else is, in most jurisdictions, referred to as an undue hardship, which is very rigorous and really quite draconian in many ways. In fact, I've seen cases where they've said, well, this borrower had enough money to own and operate in their home a refrigerator, such a luxury item as a refrigerator, therefore this person could afford to pay their student loans. And so it's very difficult to get student loans discharged in bankruptcy, but it's not impossible. And I think that there is a bit of a trend towards allowing more discharge than the courts had previously allowed, just in light of the pervasiveness of the student loan issue.
All right, yeah, makes sense. Next from Kristen. Kristen is asking, Heather, if you could give an example of a, air quote, as you say, public service job.
Oh, sure. Yeah, so that is a very, very broad definition. It has to be a full-time paid position for the government, which is state, local, federal, tribal agencies and entities, or for a nonprofit organization that is structured under 501c3 of the Internal Revenue Code. So that's going to include the majority of hospitals, the majority of universities, advocacy organizations, as well as schools, government agencies, and it's an extremely broad definition. And full-time is defined either by the organization's internal standard of full-time or 30 hours a week on an annual average, whichever is greater.
All right, and I just was scanning. We certainly have a lot of additional questions that have come in, so we'll try to do these rapid fire. And glad folks you could stay on, and hope I know a lot of folks that listen in just find a lot of value in just listening, not even so much having their questions answered. So thank you, Heather. Can a family member or spouse be the cosigner? That's from Vincent.
Yes. On a private refinancing, certainly. That's typically who it would be.
All right, great. Next from Cheryl, do the death and disability discharge provisions apply to federal Parent Plus loans too?
They do, and interestingly, it can be the death, not disability, but it could be the death of either the parent borrower or the student beneficiary on whose behalf the loan was borrowed.
Yeah, interesting. The next question that came in from Paul, I don't think they're related, Cheryl and Paul, but he is asking, he would like to know how student loans are treated at death, both for federal and private student loans.
Federal loans, the estate or survivors will file a death certificate and the loan will and can be entirely discharged. The recent tax legislation exempts that death discharge from taxation. Previously, death discharge of student loans was also taxable as income. It's now not taxable under the tax code, but that provision expires and would have to be extended by Congress in order for it to last past, I think it's 5 years. Might be longer, I'd have to look that up. Private loans generally do not address death discharge within the context of the promissory note. A few will. There's been some success with shaming lenders who have tried to collect on the loans of the dead from, for example, their grieving parents. And if enough attention is called, they can sometimes be encouraged to stop trying to collect. And some have even made public statements that they will do things like discharge loans upon death. But if it's not in the contract, they're not required to do it.
Oh, interesting. Next from Karen, she wants to understand the interest treatment under deferment and forbearance. Which one does not accumulate interest on subsidized loans?
It's periods of deferment where interest does not accrue on subsidized loans. The most prominent time that we see deferment is when a borrower is in school. The in-school deferment is the main deferment. There are also others, though. They require specific showings like unemployment. And then again, it's only the portion of the debt that is subsidized that would be subject to that interest suspension during a period of deferment.
Okay, great. I took the presentation privilege back, Heather, just to bring your site up because, again, I'm getting a question from Kristen, who's asking how does she find you in terms of working with you as a financial advisor. So what would you have folks do on your website if they want to reach out to you, other than saying, they found you through your new best friend, Tom? How would you have them do that?
That's right. So you can, if you want, you can just click the contact button there on my site, or you can click consulting to read more about the kind of thing I do. You can just send me an email. I'll tell you my email address. It's just my first name, Heather, at askheatherjarvis.com. And I'd be glad to set up a time to chat with you. I'll structure it however you want to. A lot of advisors would prefer that I work up a student loan case, brief them on it briefly, and then we meet together with the client so that I can answer questions and such. That works well. Or if you prefer to keep me behind the scenes, that's fine too. I don't mind if you pass the cost along to your clients. I don't charge very much money. I should charge more. I charge $500 for a single borrower for not unusually complicated case, meaning not default or something bizarre. $750 for a married borrower. There's a lot of complications about being married. And I don't do the paperwork or anything. I give you information about how to get the records from your clients. You get everything I need. Then I review it, crunch numbers, do projections, and then I brief you and or your clients on it. And then send you off to, implement the plan. And it's a really good way, like if you're interested in like dabbling in this and you're not for sure if you want to do it, it's a good way of kind of getting your feet wet or see, how involved it really is, because it truly is very involved. And so I encourage everyone to do it if you have any interest, but recognize you will need education and support if you haven't done it before. And you may learn, some people learn, as I have about many other fields, I'm like, you know what, I don't want to become an expert in that. I don't want to do that. I want to hire someone else to do it. And you can do that too. So.
Yeah, absolutely. Good advice. Question for you, Heather, is there a financial planning program or a technology that you like to analyze any one of these sort of situations?
Yeah, there are a few different commercial tools that I have looked at, and I'm very picky. I'm just such an awful consumer, and I don't know what it is, but my favorite one is for free. It's not that easy to use. You have to know what you're talking about and make sense of it. But it's put out by the Veterinary Network Foundation, VIN Foundation. Veterinarians borrow a boatload of money for their educations. And the VIN Foundation built a tool, and I helped with some of the back end stuff and testing, so I know it's correct. You need to keep going to that Porch concert, Tom.
Yeah.
And the VIN Foundation Student Loan Simulator is a very powerful and useful tool. It's, as I said, you've got to know how to deal with the inputs properly in order for it to be effective, and you have to be able to, describe what it is that you're seeing there. But it's really cool. I advise people to check it out. Jance has a good tool too, and I don't think he's even charging for it now. CSLA Tech, I think, is what it's called. And that one's really good. I will mention, I know we're running low on time, but right now with the CARES Act, everybody's interest rates being set to zero, it's pretty much broken all of the tools except the Vin Foundation one, actually, because they can't, the loans are all showing up as no interest. And if you don't correct those inputs, you're going to see, I mean, the government website, this is horrible. They're forcing the graduates right now to go through these exit counseling requirements where they're looking at these tools that are showing them the cost of their loans based on a 0% interest rate going forward. And it's entirely false. And it's an absolute disaster. I mean, it's working my nerves, but be careful with those tech tools right now. Make sure they're not using a 0% interest rate, because that won't be correct much longer.
So generally, for folks, parents and students that are going to be loan shopping, in particular with grad students, is there what advice would you give between the federal, especially if they, like some of the advisors have, clients who have children going off to grad school, the clients are affluent, what's the best strategy for them to look at with that grad student wannabe?
Yeah, so so graduate and professional borrowers are considered independent for purposes of financial aid. So they're able to borrow through the Grad Plus loan program up to the full cost of attendance through the federal student loans. So most people are going to get the best terms, interest rates, and everything else by just going strictly federal, and won't need to do any shopping for private borrowing. And that's because hardly anybody qualifies for a better loan from up the private market than they would for the feds while they're a student and not earning cash money, right? So it's different when you graduate from medical school and you're a doctor. You might be able to refinance at a better rate. But if you go into the private market right now and say, I want a whole bunch of money unsecured to pay for my medical education, and I'm unemployed and have no credit history, they're going to say, and you're not going to get a good loan. But the feds will give you good loans. And then after you graduate and you start making the big bucks, you can refi or, take advantage of any of the other sort of flexible things that we've talked about earlier.
Okay, and then with that Grad Plus, they, in terms of the student who's the borrower, right, they may be eligible for some kind of income-driven repayment plan on their own if, again, they're the borrower and the sole borrower, if you will.
That's exactly right. You got it.
Okay.
Yep.
Okay. Next from Eric was asking, is there a CSLP community, which is the Certified Student Loan Professional,
Yep.
where the practitioners can basically exchange Q&A? Is there a forum for that through the CSLP community?
There is, and we've very recently launched that. So we now have a whole community where people can interact with each other and with Jance and me about their cases and their practice and their questions and their concerns. And it's really cool to be able to have that support. And there's also a full, sort of resource library where you've got all the forms you need. And I have a lot of things I share, like template letters. I'm big into like sending letters to the student loan servicing companies about what they're doing wrong. I think that can help, borrowers. So, which reminds me, Tom, didn't you have a question about the secretary of the department that you were saving till the last?
Let me, if I may, to add one. I think I missed Chris's question, and stop me, Heather, if I already posed this. I apologize. I think I skipped through. Chris is asking. It's sort of a three-part the way it's presented. Upon graduation, if a borrower begins immediately working in the public service, is it correct for the 120 payments to not begin until the consolidation is completed? And by the way, one of the loans that the borrower has is a family education loan, an FFEL. It was originated and funded just prior to 10/1/2007. I think I have the elements there. Does that make sense, Heather?
It does. So the FFEL loan in particular that Chris is referring to is not eligible for public service loan forgiveness until it's consolidated into the direct loan program. The other reason why that borrower can't start progressing toward public service loan forgiveness immediately is that you have to either toll or stop the grace period. So all the loans will have a 6-month grace period. Even if you're working the first month when you're out of school, and even if you make payments on the loan, it doesn't count towards forgiveness unless the loans are in a repayment status. And that repayment status can only be triggered by the expiration of the grace period or by consolidation. So a lot of people don't need to consolidate and might just, use those 6-month grace and then enter repayment in November. But if you need to consolidate a FFEL loan anyway, maybe you go ahead and consolidate right away, and that will toll the grace period and allow you to start enter a repayment status and start making payments that count towards forgiveness right away. The other thing Chris is talking about, October 1st, 2007, that means that borrower is not eligible to choose the pay-as-you-earn repayment plan. And the consolidation isn't going to cure that. They'll still only have access to income-based repayment, or once they're in direct loans, revised pay-as-you-earn, which can be good for some borrowers, but which has limitations, especially for married people.
All right, if I may, just to sneak one more in from Raymond, who unfortunately is a recent graduate, graduated last September 2019, got a job, but just got laid off due to COVID. Can he apply for pay? His first payment is not due until September.
Yeah, so pay as you earn is a good repayment plan, and there are advantages to it. You might also give some consideration to revised pay as you earn because it has some interest accrual benefits that could be good for you, Raymond, but it's going to depend on if you're married, if your spouse has income, and whether your spouse has student loans primarily. So look at pay as you earn and consider the pros and cons of that versus revised pay as you earn. And those are both good options. You'll be able to afford your payments no matter what. If you're not making money, your payment can be set as low as zero. And you're much better off enrolling in one of those repayment plans than in requesting a forbearance. Because that will start you on the path toward at least there being some end in sight in terms of loan forgiveness, as well as the interest benefits that are available as well.
All right. Well, I hope that helps, Raymond, and good luck. Sorry to hear that you're going through that, and certainly wish you well. With that, Heather, thank you so very, very much. What a treat to have you, and incredible feedback already coming in, and job well done.
Thank you, Tom. Thanks everybody for coming. It was my pleasure. Thanks so much.
Great.